All right, in this video I want to continue our discussion of depreciation, and we know depreciation is the process of allocating a cost over time or expensing an asset over time. And when we're doing that, we're going to follow the matching concept or the matching principle. And what I mean by that is the way we allocate that cost should match the revenues generated by that asset. So if that asset generates an equal amount of revenue each year over the useful life of the asset, then we should depreciate an equal amount each year over the useful life of the asset. So to make that a little more clear, let's look at this example. And it says, assume Your Ride Incorporated paid $24,000 to purchase a taxi. It says the taxi has a $4,000 salvage and a 4-year life. So we got a $24,000 taxi, a $4,000 salvage value, and we think that it's going to be useful to us for 4 years. Okay, let's assume that we're going to be able to generate $20,000 a year in revenue with this taxi. So in year 1, we think we're going to earn $20,000 in revenue with this taxi. In year 2, we think we're going to earn $20,000 in revenue. In year 3, we believe we'll earn $20,000 in revenue. And in year 4, we'll also earn $20,000 in revenue with this taxi. So notice that these revenues follow a straight line. So this line represents the revenues earned with the taxi. So we're going to earn $20,000 a year. And so if these revenues follow a straight line, which means that we're earning an equal amount of revenue with this taxi over the useful life or over the 4 years, then it makes sense to take an equal amount of depreciation expense. So we'd use the straight line method, and we looked at that in the last video. And so to calculate depreciation expense with the straight line method, we just take the cost of $24,000, we subtract out the salvage value of $4,000, and we divide it by the useful life, which is 4. And that would give us $5,000 a year. So we would depreciate this taxi $5,000 a year. So we depreciate $5,000 in year 1, $5,000 in year 2, $5,000 in year 3, and $5,000 in year 4. So my depreciation expense is also following a straight line. This is my depreciation expense. So notice that my depreciation follows the same pattern as my revenues. It's matching my revenues. Your Ride is earning revenues equally over the 4 years, and so it's depreciating its asset, this taxi, equally over the 4 years. All right, but what if we had an asset where it didn't generate equal revenues over its useful life? Maybe it generated a lot of revenues early in its life and then less revenues later in its life. So maybe we want to make a movie and we need a camera to record the movie. So let's say instead of buying a taxi, we buy a $24,000 camera. Okay, we expect a lot out of this movie, and we think in the first year it's going to be out in theaters and we're going to be able to generate $25,000 in revenues from this movie. And in the second year it'll be out of theaters, so we don't expect to generate as much revenue, but it'll still be available on demand and by DVD and other sources, so we'll be able to generate some revenue. And maybe we think in year 2 we'll be able to generate $17,000 in revenue. And then by year 3, a lot of people have already seen the movie, so our sales are going to go way down, but we still should generate some revenue from it. So maybe by year 3, we think we'll generate around $11,000 in revenue. And then by year 4, almost everyone has seen it. There may be a few people who haven't seen it, but we only think we'll be able to generate around $5,000 in revenue in year 4. So notice the pattern that my revenues are following. This movie is going to generate a lot more revenue in year 1 than it is in year 4, and the revenues are going to decrease each year. So for this camera that I'm going to use to record this movie, I need to pick a depreciation method that matches this pattern of revenues. So I need a method that depreciates a lot of the camera early in the life and then less of the camera later in the life. So let's just say that this camera, it costs $24,000. Let's assume that it still has a $4,000 salvage, and let's still assume that it's only going to be useful to us for 4 years. So what I'm going to do is I'm going to use an accelerated depreciation method. And the accelerated method we're going to use is called double-declining balance. So we're going to depreciate this camera using the double-declining balance method. So let's look at how that works. Okay, so the formula to depreciate using double-declining balance is we take the beginning of the year book value, and I'll abbreviate book value just BV. And remember, book value is the cost minus any accumulated depreciation. And I'm going to multiply the beginning of the year book value times twice the straight line rate, SL straight line, and that's going to give me the depreciation expense. And so notice a few things about this formula. 1, we're using the beginning of the year book value. So this book value is going to change at the beginning of every year. So we'll use a different book value every year. Notice another thing is we are not subtracting out the salvage value. When you're using double declining balance, you do not subtract out the salvage value. It's just the book value, which is just cost minus any accumulated depreciation. Second, notice we're multiplying by twice the straight line rate. So you may be saying, well, what's the straight line rate? Well, the straight line rate is the rate of depreciation you take when using the straight line method. So we know with this asset, it has a 4-year life, right? A 4-year useful life. And we know with straight line, we depreciate an equal amount over the 4 years. So if we have 100%, and we're going to depreciate that over 4 years, we're going to depreciate 25% per year. And if we want to do twice that, twice the straight line rate would be 50%. So twice the straight line rate would be twice the rate of straight line depreciation. So in this case, in this example, my straight line rate is 25%. So twice the straight line rate would be 50%. And then that formula will give you the depreciation expense for the year. So let's do it for this asset. So let's start with the first accounting period. And the first thing we're going to do is we need to figure out what the beginning of the year book value is. And that starts out really easy. So if you look down here, this is my table to calculate the book value. So we're going to start the first accounting period. We know the asset costs $24,000. We know it starts out with 0 accumulated depreciation. So my beginning of the year book value is $24,000. So in the first accounting period, I just take the beginning of the year book value, $24,000, and multiply it by twice the straight line rate. And we said the straight line rate was 25%. So 25% times 2 is 50%. And that will give me depreciation expense of $12,000. So in my first year, I'll have $12,000 of depreciation expense on my income statement. All right, so let's go to the second accounting period. And so first I need to find my beginning of the year book value. So we know my cost is still $24,000. And now accumulated depreciation is $12,000 because in year one, I depreciated $12,000 of it. So we had a $12,000 depreciation expense and we put $12,000 in accumulated depreciation. And we remember accumulated depreciation is a contra asset on the balance sheet. Okay, it decreases total assets. So my book value now is $24,000 minus 12 or $12,000. So for year two, I used the beginning of the year book value of $12,000, multiply it by twice the straight line rate of 50%, and I get $6,000 depreciation expense. So that's how much depreciation expense I would take in year two. Notice that the amount of depreciation expense is decreasing. We take more in the beginning. That's why this is an accelerated method. And then for year three, we need to figure out the beginning of the year book value. And so we know our cost is still $24,000. Our accumulated depreciation at the beginning of the year two is 12, but then in year two we added an additional 6, so now it's 18, making our book value $6,000. Just cost minus accumulated depreciation. Okay, so my beginning of the year book value is $6,000. Twice the straight line rate, still 50%. And so my depreciation expense is $3,000. Okay, so based on the formula, it says my depreciation expense in year three is $3,000. But there's something else we got to check. Okay, remember with double declining balance, we do not deduct the salvage value. We don't take out the salvage value. But we still cannot depreciate the asset below its value. So what that means is that the book value of the asset can never be below the salvage value of the asset. And you can see at the beginning of year three, my book value of the asset was $6,000, right? And we know the salvage value for this asset is $4,000. So we cannot depreciate the asset such that the book value is below the salvage value. So you can see the most depreciation expense that we can take in year three is $2,000. If we take $2,000 depreciation expense, my book value will then be $4,000. That's as low as it goes. So for year three, it's not going to be $3,000. It's only going to be $2,000 because the most depreciation expense I can take is $2,000. So you just have to manually check this once you get towards the end of the useful life. And we know if we took $2,000 depreciation expense, we know for year four, that would mean we still have a cost of $24,000. My accumulated depreciation would now be $20,000. The $18,000 plus the $2,000 we took in year three. And so my book value at the beginning of the year four is $4,000, which equals the salvage value, meaning I take 0 depreciation expense in year four. Okay, so to calculate depreciation expense using double declining balance, you just follow the formula for the first few years. But once you get towards the end of the useful life, you need to make sure that you do not depreciate the asset below its salvage value, which in this case was $4,000. So we could only depreciate the asset down to $4,000. And so this is my depreciation expense that I would take each year. These numbers right here. I take $12,000 in year one, $6,000 in year two, $2,000 in year three, and 0 in year four. So let's look at those on the graph. So we have $12,000 in year one, $6,000 in year two, $2,000 in year three, and 0 in year four. So you can see that the depreciation expense for this camera, if we use double declining balance, it's going to follow the same pattern of revenues that are going to be earned from this camera. So we're matching our expenses to the revenues, and that's what we're trying to do. So the idea is we pick the depreciation method that best matches expenses to revenues.